Excited to have another episode of the Lone Star Capital podcast. It's a beautiful day. Things are getting a little bit better for you in Houston, as you may not be there much moving forward. Things are getting great for me here in Phoenix, as the weather's cooling off. And life's just great, isn't it? It's good to be the good guys.
Wow, golf has made you such a happier person.
It really has. But the weather's good. I just actually got new irons, the T150s. We're absolutely thrilled, but we're not here to talk about my golf game today. But if you do want to play golf, and if you are coming through in the Arizona area, if you're here for business, pleasure, you live here, you're an investor and a capital allocator, looking to build an enriched relationship with Lone Star Capital, the man here, the co-founder and CEO, Rob Beardsley, has given me carte blanche and a green light to take any of you out who hit those requisites that want to enrich a relationship with Lone Star Capital. Some courses that I've been taking people to, not limited to or subject to exclusively these places, but we've got True North Monument course coming up. True North is epic. Took people to the Faldo Wildfire Golf Course. Nice little track. Great day. Good pace of play with some excellent people there. And then we're going to Desert Mountain this Saturday to play with a potentially big partner and someone that Rob and I have tons of respect for him and his partner. So we're absolutely thrilled that the golf aspect of things will be taken up here, and we want to do more strategic ways to build relationships, meet people where they are. I think the golf course is such a fun way to have a conversation, maybe not about business, but there's a thing going on and there's a thing within the thing. The conversation while doing the main thing, I think, is a good way to put it. So excited about that. But on a serious note, if you are actually looking to play, to build a relationship, we're all ears and want to make it happen. If you want to take me to your country club, I'll play. If it's throughout the country, I will
Yeah,
do it.
don't
I will
don't
sign
limit
up.
yourself to Phoenix, right? You'll play. You'll
Yes.
you'll you'll fly. Your sticks will fly.
If you want to take me to Augusta, I will go. If you want to take me to Cypress Point, I will play there. If you want to take me to the Olympic Club and take me to the lake, I'll play the lake course, okay? I'm just saying. And I'll play more. If I didn't name your course, don't feel left out. You can take me there and tell me how great it is. But we're not making it about that today. But on that same note, we're actually going to be on a week-long business trip here coming up. So I would be not doing my job if I did not let everyone know we're going to be next. Speaking of which we're going to be in Florida, we're going to be in Miami, and we're going to be in Tampa Bay. We're going to go to Miami to the Ascent conference, which is which is a very substantial bulk of the people there, institutional folks, probably all institutional now they say it out loud. And then we're also going to be at Sam Silverman. Shout out to our friend Sam Silverman, who is going to be hosting the first ever fully funded event. That'll be awesome. So we're going to be there. That's going to be the first full week of November. So that's going to be very exciting. Traveling is going to go down next year for the guys here. This traveling will be different, but we're going to be being a little bit more precise and a little more strategic with where and when and what we do. And our conference schedule this year was the year to kind of figure out what we want to do. But I'm excited for that. And also, what's really exciting too, I think at this point, the episode should be released because I've asked Kurt, shout out Kurt, hope you're doing great, to put out the episode that I just shot today with Seth and Travis with TribeVest regarding the latest and greatest with our fund-to-fund partners and capital allocators and what's going on with their business model. That episode is very important if you are, in fact, an investor or fund manager, capital allocator looking to learn about what's going on, the behind the curtain look, if you will, into the business. It was very informative with some of the updates. They're excellent guys. We just got the opportunity to see them in New York City at our conference. So that was a lot of fun. So shout out to them. If you are curious about the fund-to-fund model, please, please, please listen to that show. Also, is it too early to talk about something we're doing in the Silicon Valley, our hometown and our neck of the woods in December?
Never too early.
I'm going to let you speak on it.
Okay, sure. I think it's December 18th. We'll be hosting our annual, call it a holiday party, just because it's in December.
Don't say where.
Okay, fair enough. I won't say where.
We don't want any crashers.
Your mic is sounding a little funky.
Okay. It might be your connection.
I think you're kind of far away as well. Much better.
Good. Better now.
Oh my gosh. It was like, oh my gosh.
Kurt, we're gonna ask you to leave it in. Leave this in. This is good content.
Okay, so anyway, well, I
But
was
let's
gonna,
talk about the event.
yeah. Okay, so we're back. So we're hosting a very exciting event. I won't mention where, but a very exciting location, exciting event in the Bay Area, which is where we both grew up in Northern California. And so we host our annual holiday party. It'll be on December 18. So we're looking forward to seeing a lot of familiar faces there and hopefully some new ones as well. I think our network every year grows, and this year is no exception. So we're going to be excited to welcome some new people into the network, so to speak, into the family. So yeah, if you are local to the Bay Area, or if you are willing to jump on a short flight, if you're near the Silicon Valley, please reach out to us and we'll get you information on attending the event coming up here.
Yeah, no, this is gonna be very exciting. It's kind of funny. The inception, I mean, we're gonna be in the Bay Area regardless, in the Mid Peninsula vicinity, specifically near Palo Alto. And 2 years ago, I believe it was a very small dinner. Then last year was a little bit bigger. And then this year we're going to one up it as well, if I'm not mistaken. I don't know if the format will be different. It'll be content, this, that, but we plan on blowing it out a bit and making sure that everyone who needs to be there will be there.
I love that. Yeah. So it's not bigger isn't always better, but when it's bigger and better, that's better.
Correct. I couldn't agree more. So that's very exciting there. So, one thing Rob and I have been doing, switching gears into the show, is we reached out to our entire list of friends and potential partners in the capital raising world, which is, the fuel to scale our business. And we emailed all, hundreds of people that maybe fits to work with us. And it's been very exciting. We've had a lot of great conversations these last couple of weeks. For the next couple of weeks, we've also got our work cut out for us, connecting with people, seeing the newest, seeing the latest, this and that. And what occurred to me is that I think in bits and pieces, we talk about some of the improvements and what we've done so far in 2024, which is very exciting. We've scaled nicely. But sometimes we do something, there's an improvement that occurs, something comes up, and it comes in an episode, here, an episode there, but it's not all concretely together. So I thought it would be just a really nice way to start the show and to just speak about maybe in a time frame perspective, or it doesn't have to be chronological, but the improvements and the additions that have been made to the company so far this year, because it's been a lot of a really amazing stuff that's happened, a reshuffling of time allocation, as many know who listen to the show routinely. But Rob, why don't you take it from the top as to you see, don't spare detail, as to the incredible improvements that we've made, not just from an acquisition side, we'll talk about that as well from what we've done this year, but just from an infrastructure of a company perspective.
Yeah, absolutely. So this year has been a really fantastic year, like you said, not just for growth for the firm and acquisitions wise, but also operationally. And most notably, my role this year shifted in June, basically, when I stepped in and became CEO to oversee really all the day to day operations of the business, ranging from acquisitions, investor relations, marketing, and of course, most importantly, operations. And on the operations side, I'm speaking specifically about property management, construction management, and asset management. And there's a whole lot there to contend with. We have a portfolio that has grown rather quickly, and so it requires a lot of investment in terms of time, personnel, and processes. And so that's been really my focus for the year. So when it comes to my time, I'm spending at least 90% of my time in that regard on operations. When it comes to personnel, we've really done a lot of tremendous things this year in terms of bringing in super high quality talent. We have hired an additional 2 asset managers, where we now have 3 asset managers that oversee the entire portfolio, which is now about 20 properties or so. And we also have brought in some really strong corporate management personnel that help with takeovers, help with training, help with hiring, help with firing, and so on. So we can really address all the issues and all the ways that we can improve across the portfolio. And then also, of course, not to save the best for last, We actually, there's more and more, right? I'm going to go on and on about all these operational changes.
Yeah, please.
But
Can you ramble? Please ramble because there's a lot to talk about here. Let's just get it all out and on the record.
So the next piece is bringing in my mom Ina, right? So she comes with a really tremendous background in accounting and property management, and so we had brought accounting in house earlier in the year, but she's really helped us take it to the next level and really kind of set a new standard there. And I, I hate to say this, but I never thought accounting would be so interesting and so vital, and that's really truly what it is. And so that's a huge level up. And then she's just helping a ton with operations, payroll, HR. So we're just systematically bringing in all these elements of the business in house. And then it's not just bringing something in house doesn't automatically make it a good thing, right? You have to actually do it well to make it a good thing. And so that's kind of the next level. So it's all about getting the right people on the team and then figuring out the right seats on the bus, right? To use Jim Collins' analogy, right? You get the right people on the bus, then you get the right people sitting in the right seats on the bus. And so that's been a big focus of the last 5 months. And then processes. Processes is a really big one because that's, of course, how you mobilize your talent and your efforts. And so right now, as a good example, we're right in the middle of preparing and putting together our quarterly reports. And so the quarterly reports and reporting in general is something that's been a bit of a pain point because when you have 2, 3, 5 properties in your portfolio, it's not such a big burden to prepare monthly and quarterly reporting for your investors when you're only talking about a handful of properties. But now we're talking about producing reports for over 20 properties. That can become very burdensome. And while reporting is very important for many reasons, which I'm sure we've talked about before on the show, you don't want your team to be spending a ton of time on reporting because that's really looking in the rearview mirror. It's really looking at the past. You want them looking at the future and placing their efforts on things that will positively influence the future. So when it comes to reporting, you just want to be very efficient with your time. And so that's something that I'm really proud to share because I had call it a big, audacious goal early in the year, and I didn't really have a clear vision as to how we would execute. My vision was I want to make our reporting twice as good and take a quarter of the time, right? And that's to me, I got myself uncomfortable by saying that goal because I thought, wow, how are we going to pull that off? That's crazy. But I feel like we're getting there. This quarterly report that's coming out right now is the first iteration of the new formatting structure, and putting together this new format structure, I really thought about how to get to the core numbers and analyses that investors really care about. So that way it's also saving our investors time as well, not just us time in preparing it, but it's also easier for our investors to read a report that takes them 3 minutes to look at rather than 30 minutes, right? If it's a very cumbersome or just unhelpful report. So yeah, reporting is very top of mind right now since all the asset managers, we've been in Houston here at the corporate suite for over a week. And we've just been grinding, pulling late nights, just collaborating on putting together reports and fine tuning the formatting and so on. So yeah, and then that gave me the thought about what I texted you last night about the intricacies when it comes to calculating and reporting on cash returns and things like that. So we could talk about that next as well.
Why don't you run with that thought since it's kind of top of mind here, and then we can segue into the other kind of topics that are exciting.
Yeah, so what was interesting is we have some deals that have done cash out refinances where, just to make some simple numbers up, if you originally invested $10 million into the deal and then did a cash out refi, now there's only $7 million left in the deal. This is actually a question that comes up a lot with investors. They'll ask, what is the proper way to calculate cash on cash post refi? Should you calculate using the original equity amount, or should you calculate using the residual equity amount, the amount of equity that's remaining in the deal? And obviously, the cash on cash is going to be a higher number if you're calculating it on the post refi amount because you have less equity in the deal. And that's actually the proper way to calculate it because, of course, you're looking at return on equity. You want to look at how much cash you actually have remaining in the deal and how much cash flow is that generating for you. And so the tricky thing is on deals where you do have a refi that has taken place, you kind of have a segmented total cash on cash calculation where for the first half of the deal, you have cash on cash returns calculated based on the original equity. Then you have the refi happen. And then now you have a lesser equity amount remaining in the deal. And now you have cash flows associated with that. And so you need to take those cash flows on a monthly basis based on a different denominator, pre and post refi, and then annualize that to figure out, okay, this is what the deal's actually generating from a cash on cash perspective. And you can obviously get into more finer points when you look at that. The other interesting thing when you think about cash on cash returns and refis is the preferred return. So I'm opening up a huge can of worms, and for a lot of people, this is like too complicated and just confusing stuff. But just a classic thing that people do mix up is the difference between a preferred return and a cash distribution, right? Just because a deal has an 8% preferred return doesn't mean that the deal pays or obligates itself or promises or projects to pay an 8% cash flow distribution, right? You know this, a lot of people do know this, that preferred return is just simply a partnership mechanism in the waterfall where investors get paid that minimum amount first before there's a split of the profits thereafter, right? It doesn't necessarily speak to cash flow. However, when we talk about a refi, and on the cash out refis that we've done, we actually don't return capital before or until we have actually caught up the pref. So if you do have an 8% pref and the deal's been distributing 5% the entire time, right? It's accruing, it's deficient a 3% cash flow for every period. And it's accruing that and compounding that in our case, because our preferred return accrues and compounds. And so when we do a refi, the proceeds of the refi first go towards catching up that pref and then to returning capital and paying capital down. So when you look at it that way, it's kind of sandbagging the amount of cash out refi that's actually taking place, because some of the proceeds are going towards paying the pref. So anyway, it's a lot of complicated stuff, and we have to make decisions as far as how we want to present the numbers fairly, efficiently, etc. So just some interesting nerdy math stuff.
Nerdy math stuff is how you make the big bucks and how finance works. So for those who listen to the show, probably can appreciate that perspective there. So thank you so much for kind of going into that theme there. Back to kind of the talk tracks we had with the equity, folks that we're speaking with here. What were some of the other themes that we were articulating to people, perhaps past partners that have worked with us, and kind of the next partners, would you say, from your perspective, outside of our 2025 acquisition goals, which we'll get to soon?
I'm not sure. I feel like those are kind of the highlights that we've been sharing with a lot of people. Obviously, we have been very successful based on our focus. We're heavily focused on Texas. People share deals with us all over the place, and we turn them all down. We only look at deals really in Dallas, Houston, and San Antonio. And even within those markets, we're very selective as far as the age of the property, the location of the property. And I think we're only getting more selective as we refine our buy box and just get more selective, right? As the portfolio grows, as we learn more, as we have the capability of buying bigger properties, it really puts us in the driver's seat to be focused on buying the right deals and perhaps less deals, but better all in all deals.
Without a doubt. And let's just talk about real quick the opportunities that we have in fact acquired in 2024. If you want to just go start to where we are now.
Sure. So the first deal we closed in 2024 was Regency Grove, formerly known as Aspire Apartments in San Antonio. That deal was a bit of like a distressed play, purchased from a distressed operator, and a heavier lift. So it was an 80s vintage property. It actually had a lot of crime issues when we took over. And fortunately for us, we implemented a crime mitigation program where we brought in a lot of courtesy officers. So we have courtesy officers that live on site in exchange for free rent. They provide patrol services to the property. Ever since we've implemented that, there's been 0 crime incidents. So that's been a difficult hands-on type deal, older product, rougher area, not market rate. We actually do have an affordable housing component to that deal where we have a 50% property tax exemption. So there's a bit of a nuanced wrinkle there. So that was our first acquisition. And then we did close on a truly market rate deal in Grand Riviera in Dallas. So that's another older value add deal where we have a business plan to renovate the property, increase rents, and take advantage of the very fast growing submarket of Irving, which is in Dallas Fort Worth, in between the DFW airport and Las Colinas, which is like a Class A premier business district. And then on to Houston. We've really had a great time in Houston. We've so far purchased 2 properties from Cortland. Cortland being the number 8 largest multifamily owner in the country. They're a fantastic operator. We purchased Cortland Copperleaf from them, which is the property that I'm at currently right now, and also Cortland Med Center. And now we are also under contract on a 3rd property with them as well that will close before the end of the year. So yeah, I would say somewhat diverse batch of deals, mix of affordable. All the Cortland deals are tax exemption structures, which our investors absolutely love. It's a super differentiated strategy that not a lot of people are doing. And investors really love the profile because it's lower risk, yet the returns are equally as good, if not better, than a lot of other value add opportunities out there. So yeah, we're very fortunate as far as 2024 acquisitions go.
Yeah, it's been a very positive year. I believe the goal was 250 million to start the year in acquisitions. We have something potentially coming soon. So if you want to see it, email me. I think by the time this comes out, it'll be released. So the secret will, in fact, not be a secret anymore. So that's an exciting deal, which hopefully put us to about 200 million of acquisitions this year, which is really incredible to think about. During a as people are coining it to be frozen, the market, we're able to make acquisitions when times are tough. And it seems like a general theme from the equity conversations we had going back to kind of boots on the ground. The conversations is people are scared. People are nervous. People don't know what's going on. The headlines are catching up to the industry. And we've had some very smooth, kind of talking points as to why now is actually the best time. But maybe in your words, do you want to maybe just share kind of how you view the world currently and how you're kind of overcoming that objection?
It's a very fascinating situation. I feel like it's been a little bit of a while since we've talked economics on the podcast, right? There was a while where we were talking way
I
too
know
much.
you love it.
I do. We were talking way too much macro, and I was getting nervous. I was like, every week we're talking about recession and inflation and Fed. But anyway, so it's been a very interesting while where we've seen rates peak and then really hold there for a while, and it's really killed a lot of investor demand, and a lot of sellers don't want to sell, and so there hasn't been a lot of transactions, which has been a good thing because for the few deals that have come to market, they've been kind of like pressured or forced sellers, and so there's been a better opportunity to buy at a lower cost. But of course, you're contending with higher interest rates, so there's no free lunch. But the fact of the matter is, a lot of risks that were apparent or lurking beneath the surface in 2021 and 2022 are really now baked into the numbers, or we're beyond it. So it's a much lower risk time to invest, especially if you have your capital structure in order. And we've pretty much been doing all of our deals with fixed rate debt with 5 to 7 year term. So it's a much better risk profile than buying at the peak pricing of the market with very high leverage with a floating rate loan when rates are low and anticipated to go higher. And so it's really all those features where we find ourselves in a completely different part of the cycle. With that being said, though, of course, I do feel a little bit conflicted because I think the economic data shows some deterioration. So I think that we could see a economy-wide broad-based recession in 2025, which would impact rents, occupancy, collections, and essentially net operating income of multifamily properties. But with that would be paired with aggressive Fed rate cuts. So of course we're going to see interest rates come down. So it's like you've got opposing forces of interest rates going down, which increases property value. But if NOI comes down due to a recession, then also that would bring down property value. So I'm a bit conflicted. Like the stock market's at all-time highs. where is it going to go from here, right? I feel like there's a lot of money on the sidelines, which also would make an argument that when that money does want to all start chasing real estate again, it's just going to make real estate values go crazy. So I feel like it really could go either way. And the beauty about that is our business doesn't rely on being able to bet or predict the future. We're just investing in good fundamentals at every part of the cycle. So we don't actually have to be good predictors of the future. We don't have to have a crystal ball and be successful.
Rob, you know what I find to be really interesting?
Hmm.
What I find to be very interesting is how everyone was trying to invest every penny they could, dollar they could in 2021 and 2022. Well, guess what was going on then? A lot worse fundamentals that we're seeing right now. It is very plain as day that the fundamentals to invest in today's market are night and day better. And if you invested during those years, you would be very silly to not invest in this year, in the next year, in the next year. Because quite frankly, the variable things that we're talking about here is debt and cap rates. Well, most people that invested in 2021 or 2022 did not, in fact, lock in fixed rate debt. And those are the ones that are struggling. If you, in fact, likely locked in a deal with fixed rate debt, you will by and large be fine or probably don't have that much risk to their capital in most instances. But right now, when you've got positive leverage and or neutral leverage or deals that are somehow getting to maybe a 5 cap, a high 4 cap if you're in a gateway core plus market, or like a 5 cap to a 6 cap in a Dallas or a Houston, and you're going in with positive or neutral leverage below replacement cost, that's how you make money in this business, by investing and managing the property well, of course. I think that goes without saying. But as Barely Sterling said, you may have heard of him, kind of an influential guy. How do you do well in this business? Okay, well, it's simple. You buy on positive leverage, with positive leverage, and below replacement cost. Every
In a
single
growing
deal we've
market.
done, with the exception of one, has been in a growing market. Every deal, with the exception of one, which was Grand Riviera, which are yield on cost, which basically gets us to that neutral or above positive leverage, is a deal in which we bought on positive leverage. Okay. These deals have been juicy and frothy. And guess what we're also seeing right now? Oh, a little thing called cap rate compression coming down as the debt market goes down because equity is back to coming into the market. There's a lot of dry equity, a lot of dry powder that's stale equity, say stale dollars, and are not coming into the market. Maybe they're more interested in pref notes or debt investing right now, but institutions are starting to flock back into it, and retail capital will be the last to it, like it always is in these parts of the cycle. So we're seeing it play out in real time. I'm not telling you what to do, but I'm going to tell you what I did. I sold my house to put more property or more equity into our deals at positive leverage. That deal will pay off very nicely. I also rolled every single bonus that I've made this year into deals. And I've also put more cash on top of the two things that I just mentioned. And we'll keep doubling down on those opportunities, likely indefinitely, but particularly right now, because right now is the time you take these risks. Okay. The fundamentals I do not see will be getting much better than they are today. Maybe the debt will get better. Okay, that's probably certain because we're at the debt high, but we're also probably at the cap rate high. And quite frankly, I am a basis play investor and location investor. I am not a debt investor in the sense that I will invest on good fundamentals during every basically point of the cycle. But that is my forecast right now. A lot of our, more syndication, fund manager, capital allocator people, they're very excited for the opportunity, but they don't know if they've got the ability to raise. And a lot of people have asked us, what are you saying? And the message is that if you were bold enough and crazy enough to invest, like I did too, and you did as well in 2021 and 2022, you better darn well be doubling down on the investments today and the next year and the next year, because this business inherently is cyclical. What say you?
Yeah, you nailed it. It's really quite a shame if someone invested their hard-earned dollars in 2021 at the peak of the market, and now that capital is likely impaired, and that's precluding them or influencing them not to invest right now. That's a big, big shame. You know, if you made a quote unquote mistake, which it's not a mistake. It's just that's how the market is. The market is cyclical. You're not always going to buy at the bottom, and you're not always going to sell at the top. So it's understandable, but yeah, you can't really let that stop you from investing now, which is arguably, or not arguably, just definitively a much better time to invest.
Absolutely. So if you are a capital allocator or an investor waiting to know what's going on, the stock market can move at any second, right? The real estate business is a slow moving business. It takes time for everything to be digested. We're going through that right now. I'm not even saying 2025 will be an incredible year for rent growth. I don't necessarily believe that to be true, but I do think that cap rates are going to go down. In 2026, my prediction and yours, and I'm not the only one saying this because Yardi and CoStar agree with me. Rent growth is about to be great because the supply will likely most by and large will be delivered, which means value add plays will be very frothy opportunities.
Yeah, and I talked about cap rate compression. I'm not necessarily looking forward to that, right? I don't want cap rates to go down because that's just going to make it harder to buy.
No.
And what I want is just a good stability is what the market needs. You know, these dramatic moves of interest rates racing up and then getting cut aggressively down and cap rates going crazy. That's not necessarily helpful to us. A stable market where there's a reasonable spread between cap rates and interest rates, that's a very fantastic environment where it's predictable. We can pick our spots, we can buy in quality locations, we can buy quality assets, and we can make sense of the numbers.
So yeah, all very exciting stuff. And I just really wanted to harp not to, be annoying here, not to act righteous and high and mighty on it, but just as a pep talk to you, if you're really struggling about where to place capital, if placing capital is a good time, if raising money is a good time right now, like, hey, the facts are the facts. If you were willing to invest in a sub 4 cap rate, then the opportunity to get into a 5 to a 6 cap rate should make you very excited. So, just take that there, take it for what it is. I'm not telling you what to do. I'm just telling you what I'm doing. And I think you probably should too. But that is that there. Very exciting. So 2024, just to go back to it, we are going to probably acquire about 200 million, 50 million shy of our goal, but an incredible goal nonetheless. And then let's get into the 2025 goals. So, very excited to tell people what our ideas are, and then you really also wanted to hit on this kind of point in conversation for the podcast today. So, kind of get into your thoughts, how you kind of came to these conclusions, talk about minimums, number of deals, deal size, so on and so forth.
Okay, yeah, this is a great topic because with acquisitions, you have to be very strategic. It's tempting to run around and chase every deal that hits the market because you just never know, right? You never know where a good deal could be or what a deal could look like. So acquisitions is a bit of a exercise in patience. It's an exercise in restraint as well. And with that, we've been refining our buy box, like I mentioned earlier. So really trying to key in on the type of assets that we truly want to own, that we truly think are the best buys. And then by the numbers, we're trying to stick to a $40 million minimum acquisitions price. And we're doing that because we want to, of course, focus on institutional assets. And everybody knows that $1 million deal is just as much work as a $100 million deal. So we can be more efficient with our time and our resources and our talent if we're focusing on larger transactions, 40 million and above. Of course, we'll make exceptions, but ideally, we can more efficiently grow the portfolio through those sorts of acquisitions. And then also something very unique, which I don't think I've really ever heard anybody say, is our strategy includes not doing any more than 6 deals per year, right? I've heard people say, yeah, I want to do 4 to 5 deals next year, or 6 to 8, or as many as I can, right? But I've never heard anyone say, I want to do no more than 6. And so I think that's really valuable for our business because it puts a very clear picture in our minds of what we want to be doing in a year. And it also puts a clear picture in our investors' minds as far as what they can expect from us. So the reason why we don't want to do more than 6 deals a year is because if you start doing a deal a month, your investors get fatigued. That's problem number one. And number two, we would get fatigued, right? It's just a lot of work. And our team would be spread thin. We would be constantly in deal mode and closing mode and buy mode. And that's just not necessary. And so for you, actually a third point on the fundraising side of things, on the investor relations side of things, not only are investors going to get fatigued because we're sending them an email every month saying, hey, new deal, new deal, new deal. Uh, you also, as someone who's handling investor relations, has to talk to investors, and you're still trying to fund deal A, but you're already talking to them about deal B, and maybe deal C is around the corner. And so investors are going to be overwhelmed, number one. Number two, they're going to ask you constantly, well, which deal's better? Which one should I invest in, Craig? What should I do? And it's just totally unnecessary. So the way that you overcome that challenge is by simply packaging up deals. And instead of having deal A and B go out separately, you just combine them as a little portfolio, and you go to your investors and say, hey, we're doing a two-pack, and these are the two deals, and basically you can invest in the two-pack or you can't. And that simplifies the fundraising process. So we keep it to 6 fundraisers per year, which is about one every 2 months. Obviously, you might not hit it perfectly sequentially, but that would be the idea. And then ideally, those are just a single deal, or maybe it's a two-pack if there's 2 deals that line up at the right time for us in the market. But I think those are some good principles that will efficiently allow us to buy the best deals and still achieve our growth goals, which is next year we want to acquire 250 million in assets. And of course, we'd rather do that by buying 5 deals than by buying 10 deals, right? $50 million average size rather than 25 million average size.
And then do you have a preference for where the deals will be, or are you pretty agnostic with what the profile is? It's just the best opportunity, would you say?
I would say realistically agnostic, but if I could absolutely just pick and have my choice, I would pick Dallas because we have fewer assets there, and I would like to build up some more scale in Dallas. The same is true with San Antonio. We only own 1 asset in San Antonio, so I'd like to get scale there as well, but truly agnostic as far as within our markets of focus, which are DFW, Houston, San Antonio.
Incredible. Yeah, well, there's a lot of stuff going on that's very exciting on the acquisition front. The goal, as I said once more, just to summarize it, no more than 6, and no more than 6 deals, and around 250 million would be incredible, with rare exceptions for other opportunities. Now let's get into a topic that's a little bit different, which is something we've been sitting on for some time, which is occupancy, and this is something with economic versus actual. So this is something that you've really been focused on while we have really revamped our tenant profiles on many deals and just really revamping who the right tenants are for the properties. So can you kind of get into your thought on this podcast topic, please?
Yeah, so the unfortunate truth about occupancy is it is a premier vanity metric. If you ask me about a deal, or if an investor asks about a deal, what's the first question they ask? Always, always, always is, what is the occupancy? And for good reason. I mean, occupancy is a very standard metric. It does give you a sense of, okay, is the deal fully occupied? Is it performing well? Is it vacant? And everywhere in between. The problem is occupancy can be fudged. Occupancy doesn't tell the full story. So just like any vanity metric, it doesn't tell you the full picture. And so what occupancy doesn't tell you is those occupied units, are they paying rent, right? Just because occupancy is high doesn't mean you're actually making any money. You could be occupied full of non-paying tenants. You could be occupied at low rents when realistically your rents should be higher, which is a pretty classic, well-known concept that people like to say, which is if your occupancy is higher than 95%, that likely means your rents are too low and you should be more aggressively pushing rents, which will naturally push occupancy down to 95%. I kind of take issue with that a little bit. I actually think that in a perfect world, you'd push occupancy a little bit higher than 95 and not squeeze every last dollar out of your rents, because when your rents aren't totally maxed out, I think that helps with turnover, and turnover is actually the real silent killer. So, and guess what? When you ask about an occupancy rate for a property, it speaks nothing to the turnover rate. And the turnover rate is basically the percent of tenants every year that leave you. And ideally, your turnover rate is as low as possible. Or said oppositely, you would want your renewal rate to be as high as possible, right? You don't make your money on leases, you make your money on renewals. That's really the magic. Because when a tenant signs up for a renewal, that means you basically got them to agree to stay for another year and to pay rent for another year, and you have virtually no costs associated, right? You don't have marketing costs to go and get that new lead. You don't have to pay any leasing commissions or locator fees or anything like that, let alone all the make-ready costs associated with getting a vacant apartment ready for a new tenant to move in, which is could be new flooring, paint, appliance repairs or replacements, countertop repair and replacements, any upgrades necessary, lighting, hardware. I mean, you're talking about potentially a full unit renovation when it's all said and done, just to get someone to move in. And then if your rents are a little bit too high, or if you're too aggressive with your renewal offer as far as your rent, they might choose to leave, and now you have to do it all over again. So renewal rates are super, super important, and again, are not factored into your occupancy rate. So these are some of the concepts that require taking a look behind the curtain and digging in a bit deeper to really assess the situation and figure out how to truly improve operations, which unfortunately it might mean actually driving occupancy down for a period of time in order to be able to, I hate to say it, but move out the bad apples and bring in the good apples and bring in people that want to stay and pay.
Awesome. Well, Rob, thank you so much for breaking that down. That's been something that you've, of course, know too intimately well, pertaining to move-ins, move-outs, and the fundamentals of managing a property better. You've gotten your PhD, and you're already ready to do your master class in your next book, I'm sure, on property management and asset management from your experiences over the last 6 months. So exciting stuff there. Final topic of conversation here that I want to bring up and speak on is something that came out from Globe Street. It was an article that Bradley Oliver sent us, our incredible director of acquisitions. And he mentioned something that the deals that have sold this year, really, actually 80% of multifamily transactions over the past 12 months have been 2017 vintage or newer. So we've kind of spoke about this recently. This trend definitely does make sense. But it is interesting that over the last 12 months, that's been the case. And I think largely that's due to the fact that a lot of deals that maybe are older than that either are kind of in their extension periods on maybe their bridge note because it could be underwater. It could be a multitude of things. Maybe, a sponsor bought a deal in 2022 with fixed rate debt and did the smart thing and has no need to transact due to where the market's at. But be curious to hear your perspective as to if that surprises you, if that's right on line with what you're seeing, and kind of your overall take there.
Yeah, that's absolutely in line with what we're seeing. And it makes plenty of sense for two primary reasons. Reason number one is developers are much more willing to sell than long-term operators. So a lot of these properties are being delivered, and then although they're being delivered in a bad time, the developer's still willing to sell them because they're in the business of building, not in holding. So they want to build the deal, lease it up to some extent, and then sell it. And that's what you're seeing. A lot of willing sellers. Like right now, the reason why a lot of deals aren't selling is because the seller's not willing to sell, right? Because prices are too low for a seller to be happy to sell. But with the developer, they build it, lease it up, and they're happy to sell, even if it's at a loss, because they can effectively get maybe even a worst case scenario, some of their capital back and move on to the next development project. So a big segment of the market that's driving ongoing transaction activity are developer sellers. And then the next piece as to why 2017 vintage deals and newer are transacting the most, or makes up 80% of transactions, is because of the buyer side. The buyer side are institutional buyers. And so institutional buyers are now coming into the market. And even if they're not institutional, even if they're buyers like us, we're also coming back into the market. And because there's fewer deals on the market, we kind of are focusing on buying the best quality deals, right? Like we talked about this last week. Not a lot of people are interested in buying older property right now because they kind of feel like they have the pick of the litter. So they're picking newer properties. So all the focus is being channeled towards these newer assets. Institutional investors certainly won't touch anything old. So it's kind of the concept that the highest quality assets maintain the highest level of liquidity in times of stress or recession, decline, and things like that. And that's the period that we're in. So people are still willing to buy a brand new deal that's well located in spite of the capital markets right now.
How many deals that are new built would you say are a little bit underwater or just have to train hands because developers need to offshore them, or not offshore them, but wash them out of their books?
I have no idea. I would I would think that this, I really don't know, but I'd imagine quite a lot, over half of them probably.
Right, right. And just for people to know, people try to get leases up or them leased up to a certain extent, and then they sell them. Maybe a group buys it on a bridge loan because it's not at that agency needed occupancy of about 85% to make it size up for long term debt. So they buy them there. But very interesting topic there. That's something we'll keep trending and looking at. We will likely want to buy deals like that, but the price has got to make sense below replacement cost with a good cap rate, and we'll be absolutely thrilled. But thank you so much for listening to another episode of the Lone Star Capital Podcast. As mentioned, we have got our Menlo Park event coming up. There you go, Menlo Park. Not going to say where, but in the Bay Area, Mid Peninsula on December 18th. If you're going to be in the vicinity, let us know. And then on top of that, we've got Miami and Tampa Bay coming up. If you are a capital allocator or investor looking to meet, holler at us. Thank you so much for being here. Peace.